Hey, good morning, everybody. I hope, well, afternoon as it is now. Hope your day's been off to a good start. Hope your week's been good. I'm glad to have y'all join me here. Um, this is going to be about a 45 minutes, then a 45 minutes of break. And what we're going to do is we're going to cover a pretty broad spectrum from banking 101 to financial business ratios. Some of it may be rudimentary for some of you. Some of it may be hard to grasp, but at any point, at any rate, you will walk away with some important things that's going to help you, your business to grow and succeed. Well, thank you. Again, this program is brought to you by the South Carolina Small Business Development Center. We're funded in part by agreement with the Small Business Administration. We're also a member of America's Small Business Development Centers nationwide. We were pretty much a charter member, started in 1979 for South Carolina. We also get funded by Department of Commerce, South Carolina Department of Commerce, that is, the South Carolina Legislature, and 4 universities, our university consortium of Clemson, USC, South Carolina State University, and Winthrop University. And what we do is we provide the tools, training, and resources to help small businesses grow and succeed. And our mission is to advance South Carolina's economic development by helping entrepreneurs grow successful businesses. And we do that throughout the state through a network of 20 different locations. We partner with the universities that I mentioned there. Our locations are located strategically throughout the state, so no one's too far from one of our offices. We have 50 plus or minus business consultants and 5 business consultants that are very similar to myself. For the SSBCI program. So what we do under SSBCI, we provide services that fall into 3 different areas. We help us financial advice and assistance, establish banking relationships, advice on financial management, identify sources of credit, capital, other financing. We help you understand the impediments to getting financing and to help write business plans and prepare loan applications. We also help assist in accounting services with setting up bookkeeping systems, learning about your accounting practices, maintaining good records, and helping you create financial statements, which are going to be very important as you apply for any type of funding. And the third area that we provide technical assistance is in legal guidance, where we help you learn different types of business structure, obtain licenses, registrations, and certificates. We help you with succession planning, transfer of ownership, although that's more done through our legal team, where we partner with Turner Paget, and they provide up to $2,500 of pro bono legal assistance. And we also partner with the USC School of Law. So some of the services that we offer, first of all, is no cost one-on-one confidential counseling. We're funded through the Department of Treasury, and so our costs are not really passed on to you. However, they're not free, and that we're going to ask you to do some assignments, work on your business plan, work on your cash flow statements, anything more than that. But it's going to take some effort on your end to help us succeed in what you want to do. We also work in the area of capital acquisition, which is what this program, as training event, is more about. We work with financial management on the same aspect. And what you're experiencing right now is one of our business training workshops. On our website at SCSBDC.com, you're going to find a section there that says training events. If you select training events there, you're going to find a myriad of events that we've done throughout the years, as well as ones that are coming up. So it's free, and we invite you to take a look at that. If you need to have more information on how to operate QuickBooks, we've got that there. If you're interested in how to start a food truck, we've got that there. So cover a pretty broad spectrum. We also work with strategic planning, financial management, marketing and growth strategies, procurements, certifications, and innovation and product commercialization. We have experts in these areas, so you're not going to find one consultant that can do all of these. But what we do is we find the person that's best fitted for you and suited for you, even if they're across the state, because we've got the capability of Zoom like we do right now. So, but, but, basically at the core, we're a teaching institute, and we don't do the work for you. We provide you the tools, resources, the knowledge and expertise that are needed for you to complete your tasks. Now, a little bit about me. I am a business consultant. I've been in business 15 years, and I've started a business, grown a business, and disposed of business. The first business that we did, we sold it after 13 years. The second business and third business both had to be closed due to health concerns of the main income producer. So that's one of the things that I like to counsel people towards, is make sure that the full brunt of everything isn't falling on you, because health could interfere with your business and your income. Yeah, a little bit about me. So what our agenda today looks like, this will be the first section of the agenda, and then we'll have a second section. What we're going to do is we're going to start with a discussion of the different types of capital, what is meant by the terms traditional and non-traditional financing. Then we'll also dive into some myths and a lot of the realities of funding a small business. Following that, in the second section, we're going to ask and answer the question, I guess, what, why, and why not of various types of financing. Then we'll talk about everyone's favorite topic, credit. And from there, we'll talk about the big three financial statements. Let's start with types and sources of financing, AKA capital. If y'all would bear with me, if you will put in the chat box where some different capital sources, cash sources might be. It can be a commercial bank, or, well, I'm not going to give away the answers, but where do you think you would find money for your business? We've got grants, we've got friends and family, grants, community loan fund. There's someone's been out there. Investors, VC, venture capital. Very good. Yeah, so far me, I agree. SBA, these are all great answers. Very good, thank you. All right, well, now that I've done that, let's take a look at a quick economics lesson to take a look at why we need capital. There's 4 factors of production, which you may have learned in economics in high school or college or somewhere along the line. But both basically land and labor. Well, land is being the natural resource that can be found in or that are used to create your goods and services. The labor is the people that you hire and the effort that they put forth to produce your good or service. And there's also you. You're the organizational, you're the risk taker, you're the one that's getting this business going, and you're the one that takes it whatever direction it can go. And the final is capital, financing your business. Capital, cash, I guess you want to say, is the lifeblood of any business. All businesses need capital, need cash to grow and thrive. As a business owner, one of your primary goals is to basically not run out of capital in cash. So not all money is the same. We've got debt capital, which is money owed by one party to another, which could be you owe money to the bank, to your mother, friends and family, your rich uncle in Cleveland. And then equity is ownership stake in a business or an enterprise. Let's take a look at, kind of the differences between the two. Typically, a debt you're familiar with is paid over time, can be short or long-term, may have a fixed or adjustable interest rate, but it does have an interest rate attached to it. Typically, that interest is tax deductible. One thing that's beautiful about debt, it does not have any claims on future profits, and you'll see what I mean by that when we talk about equity. Does not dilute ownership, and collateral and personal guarantees may be required. More than likely, they will be required. As far as equity goes, it does not necessarily need to be paid. Typically, it's not required to pay dividends or distributions on the equity plan. However, let's get some drawbacks. Equity has a claim on all future profits and value of the business. Dilutes ownership, equity, and it may come with a say in future business decisions. Now, equity is money that people have invested into our company, venture capital, as someone mentioned. So I'm going to use an example of two people I'm working with that are working with a venture capital firm in the Low Country. The one lender or one of the companies, they want to install CEO as well as 3 of the 7 board members on their firm, along with the equity they're providing. So there's where you're seeing your ownership is diluted and your future business decisions may be hindered or hampered. The debt market is about $40 billion nationwide. Equity market is about $20 billion nationwide. So the debt is actually more popular. But what we're saying too is that you can both use a combination of debt as far as and equity to fund your business. Now, okay, let's take a look at the sources of capital. You're going to notice that each one of these are going to have an E, a D, or a G after it, which indicates whether it's a equity, debt, or gift. So there's many sources of capital today. There's a lot. We're going to focus on those that are most relevant to small businesses, and it's not exhaustive. It does capture pretty much the primary capital sources for you. Later in this presentation, we're going to dive a bit deeper into the various sources. We're just going to dive a little bit deeper. So first, personal savings and bootstrapping, equity and debt. Family and friends and commercial banks. Family and friends is equity and debt. Commercial banks and grants, gifts, pardon me. Commercial banks, debt. Community banks and credit unions, debt as well. Micro lenders, debt. Community development organizations could be either equity and debt. And then you've got the state small business credit initiative, which I'll be talking about in a little more detail, of course, as we go. It's a form of equity or debt. SBA, venture and capital and angel investors, seller, supplier, and vendor financing, fintech and collateral-based lenders, crowdfunding and peer-to-peer lending. And all these we're going to take a look at in detail in the second part, the why, the what, the why, and the why not. Interesting statistic. It looks like about large banks and small banks comprise about 73% of the market. Looks like fintech or online lenders cover about, I guess that's 22% of the market. The thing is, the most business owners expressed most dissatisfaction with the fintech lenders. And we'll go into that in a little more detail. But now let's talk a little bit about the differences between traditional and non-traditional financing. When we say traditional financing, we typically mean financing obtained through a traditional institution such as a commercial bank or a credit union that you see on the corner in the street in the city where you live. And then non-traditional financing is everything else. So let's take a look at where those fall, the ones we talked about in the silo of traditional versus non-traditional funding. Traditional funding is ideal if you qualify and have patience. You've got commercial banks that provide fixed and adjustable rate loans, lines of credit, commercial real estate loans, credit cards. Then you have the community banks and credit unions that pretty much do the same thing as above, just more with a community focus. Okay, yeah, firmly, those are traditional financing. And then you've got the traditional, non-traditional, where it kind of blurs the line a little bit. For instance, the Small Business Administration, SBA programs, they offer a number of assistance programs. However, 99% of the time, they do not actually lend money. They provide guarantees to the lenders or other providers of the capital. So an SBA loan is really not considered a conventional loan, but they do finance a great deal of small businesses. And then you've got venture capital. Those are typically reserved for faster growing companies that can scale up quickly, grow quickly, and then have the high likelihood of an exit or a sale in 6 to 10 years. And now in the non-traditional bucket, you've got state small business credit initiative. Again, we're going to go in these more detail: microloans, community development organizations, angel investors, venture capital, fintech, seller financing, collateral-based financing, crowdfunding, peer-to-peer, and grants. Now let's take a look about the lending process and the common myths surrounding it. Let's just start with the basics of a bank. Okay, so I'm not going to have you all chirp in live when we would, but what is a bank? It's a licensed institution that accepts deposits and makes loans. And as a business, which side of that are we on? Well, depends. If you're depositing in the money, you're a supplier of the capital. If you're withdrawing, taking a loan, then you're a utilizer, a borrower for the capital. But at the end of the day, the bank's a business. Click through this. But at the end of the day, it's a business. So what business are they in? What product or service do they offer? I mean, this seems obvious. I don't know what you guys have here, but money. So how do they get the money they're selling? From deposits from you and me. How much does it cost them? Well, it costs them the interest on deposits and transaction costs, I guess expenses in offering services like free checking and free ATM and so forth. And what's their price? What do they charge? And that's the interest rate. The next question in this complex case study is how they make money. What the bank does, it takes deposits and turns them into loans. They maximize the spread between price and cost of revenue. So you can see that we've got this little bar graph chart, if you can see it, but they're going to borrow the money at a low interest rate, which is basically our deposits. And then they're going to lend it at a higher rate, which is what you're going to do when you borrow money. So price is the interest fees charged by the borrower, cost is the interest paid to depositors. Let's take a look at this graphically. You've got, consumers. We're making our deposits into the bank, and ideally, as a consumer, we should find the one that gives us the most bang for the buck. The banks are all competing for business, and some will offer higher interest rates, some will offer reduced fees, so forth. But it's good to shop around for that. So we make deposits in the bank. The bank must set aside a portion of each dollar it receives, 10%. And that's just to cover when I come into the bank and say, I want $100, I want $1,000, they have cash there on hand. They just hope they don't get all the demand at the same time, like it happened to Silicon Valley Bank in March of 2023. Everyone wanted their money, and they only had about 10% of it there. They're going to lend the other 90% out. The interest earned on that lending is 8%. From that 8%, they're going to pay employees, overhead, taxes, and then they're going to pay you interest on your deposit of 1%. So as far as banking 101, net interest income equals interest earned minus interest paid. The net interest income is where they make their money. And you got more depositors, more deposits, more money to them in, more interest earned. Myths or realities? Which is which? Banks don't really like lending money or only lend money to companies that don't need it. Well, you see that banks are in the business of lending. That's where they get their income mainly. But they also are keen on the return of the money that they lend. So the goal of a borrower is to ensure that they are viewed as a good loan candidate by the bank. Banks don't lend money to small companies and startups. On average, it's true. Remember, they want to get paid back in full and on time. However, new businesses have a very high failure rate and no real track record. But some lenders do lend to startups, and we're going to point those out as we get further into this. Online lenders aren't trustworthy. Well, I think we take back to the earlier slide. They just don't have the infrastructure and the overhead most traditional banks do. Therefore, they really can't respond to your issues the way a conventional bank can. Also, you're going to find their interest rates are probably a little bit higher. I would not say they're not trustworthy. They're just not regulated by the FDIC, controller of the currency, Federal Reserve, and so forth. So it's really not a matter of fact them not being trustworthy. It's just it's difficult to get in touch with a live person when you need help. Obtaining a small business loan is a long and arduous process. Well, it can be. Again, the bank needs to prove, well, it needs you to prove to them that you're a good credit risk. So what they're going to do is look under every rock and turn over every pebble during the underwriting process. And that's going to involve a lot of paperwork on our part, your part. And we're going to talk about ways you can better be prepared for that through the employment of an SBDC consultant. Back on the long and arduous process, the small business loan, it takes a while for us to get the paperwork together to get to the underwriter. And we're going to go into this more detail, so I might be wasting my breath. But it takes a while on our end, the consumer's end, to get our paperwork together to get to the bank. Once the bank has it, they're probably and could usually do, in my case, find other things that they need in addition, which slows down how quickly they can turn around the money. I've seen it anywhere from 30 to 90 days turnaround. So you don't want to wait till the last minute to try to get money. Using other people's money is the key to success. Yeah, debt has its place, and leverage, I guess, is another word you can use it. When things are going as planned, your leverage can magnify the returns on your business. However, it does introduce a level of risk into your business. So when things do not go as planned, it can magnify the downside as well. You must have a high credit score to obtain a loan. Well, yeah, the higher the credit score you have, the better. No question about that. We'll talk about credit in a little more detail, but it's a numerical representation of how you handle debt. Have you paid it on time, over time? And your past performance indicates your pretty much your future performance. So your credit score really is a picture of your past performance. But I do want to point out having a low credit score or lower credit score doesn't really keep you from getting a loan. There's a number of lenders who work with borrowers who are credit challenged. How's that one? Finally, you have to write a business plan. No, you don't have to, but you should. I do have some lenders that require a business plan, but the business plan is more important than that. It's a best practice. It's a roadmap that you're developing. It's going to help you reach your destination quicker. It'll help you anticipate and avoid obstacles, roadblocks, and excessive expenses if it's reviewed. The business plan is fantastic. I don't know how much we're going to go into that. I'm just going to do it right now. We've been submitted, we get business plans with every client pretty much that we work with. Lately, I've been receiving some that have been done by consultants or have been done by AI. And I it's hard to adjust. The business plan is written by the owner because they have ownership in their business, and here's what I want to see it do. By having AI or something else do the plan for you, you're not taking ownership in that. And you're not, it's like someone wrote your business plan. And is this really what you want to do? Is it just eloquent? But so I recommend that just working with us and developing your business plan, you're going to be able to get one that's personalized, one that's going to be shorter than an AI, that's for sure, and one that's going to be more concise as well that the lender's going to want to look at. Let's take a look at the lending process, starting with a borrower. First thing you want to do as a in the capital acquisition process from your perspective is what is the money needed for? Is it a real estate purchase? Is it land and building? Is it for new or replacement equipment, assets, startup, working capital inventory, business acquisition, and so forth? For instance, you just got to take a step back and take time to assess where you are and what you need when it comes to capital. So you're not going to make an unforced error like taking out a daily pay merchant advance and high interest rate. That's what happens when we put it off too long to apply for capital. What the process looks like again from the borrower. We're going to help you decide the best type of capital, whether it's equity or debt, the best source of that capital, the best term, and how affordable is it, the rate and the down payment, which is also part of your capacity. So once we've got this in order, what we're going to do is start gathering the information we need for documentation in order to borrow. You're going to need a business plan and financial projections. Again, highlighting that, that's where we come in and specifically help. We do have banks that will get a loan package from an individual and they'll call us and say, it looks like they're a good risk, but we just need the information compiled together. We need a better business plan. We need their financials to be tuned up a little bit. So we get referrals from the banks to help them improve the loan package that they receive. You're going to need personal and business tax returns. um, Generally speaking, I guess from a bank's perspective, when it comes to lending, your time in business is based on your tax returns. If it's not reported in your tax returns, that it really didn't happen, from the bank's point of view. We've actually got some clients, I don't know if they're clients any longer, but come a thriving business. I mean, just great guns, but they have never filled out any tax forms. They're doing it all in cash, and we can't help them get anywhere with that. That's pretty much tax avoidance. Pardon me, that's tax evasion, I guess I would say. And then you're going to need personal financial statements, business financial statements, as well as personal and business credit reports. Yeah. So again, going to the credit reports, we'll get in a little more detail, but don't wait until right before you apply for a loan to review your credit reports. And we're going to talk about this and you'll get it on the handout, but you can get a free copy once a year. Actually, it's more often now from major credit repositories. You can also get your FICO score for free at myfico.com if you want to see what your credit score is. They'll also try to upsell you there. Just go with the free plan. All right, from the lender's perspective, what looks like the traditional process, I guess we'll add, they want to discuss with you your needs and your eligibility. This is where a relationship with your banker is pretty important. I mean, the first time you talk to your banker should not be when you want to buy a loan. Over the time that you have a bank account with them, interact with them. Tell them, hey, you may be looking into a loan. What's going to be required from that? And just kind of leave it with that, but just work on your rapport with them. I remember when I opened up my first business checking account, I asked the banker, I said, I'd like to get a business loan. And he just pretty much said, no. I needed at least 1 year of tax returns before they even talked to me. They did offer me a business credit card, which I don't believe I took at the time. But so that year of time, I could have built rapport with him over the period while I was waiting for my business to grow. You gather the needed application documentation. You're probably going to fill out an application online. And then there might be some other documentation that they require. Then the loan is submitted to underwriting. Well, you submit your loan paperwork, and then underwriting is kind of like the Wizard of Oz, a dude behind the curtain, uh, where what they're doing is, again, making sure that your loan package and the documentation is true, for one thing, and if it's valid, it's up to date, and also that it meets the guidelines of the loan you're applying for. After that, hopefully, you will receive conditional approval or denial, condition satisfaction. Then finally, closing and disbursement. You get your check and you dance all the way home. So let's take a little bit of some of the terminology you're going to come across as you work with banks, or just, more working with banks. First is, pardon me, annual percentage rate. It's I always ask for the annual percentage rate because some alternative lenders have an alternate way of calculating interest, but the APR tells you the true cost of borrowing. It's designed to allow you to better or more accurately compare competing loan offers or terms. The co-borrower and co-signer, they sometimes sound the same. Sometimes they're used interchangeably, but they're different. A co-borrower is a joint applicant. both part or all the parties are borrowing the money and are equally obliged to repay it. Now, cosigner, on the other hand, is only liable if the borrower fails to make payments. Term sheet, it sets forth just the general terms the bank is willing to lend to you based on a list of conditions and what are called reps and warranties. I won't go in a whole lot of detail on that. The commitment letter is a legally binding commitment. The bank is saying, hey, we're ready to lend you the money based on these terms. It's legally binding versus the term sheet. And then finally, once all that's taken care of, you get your loan agreement, which is the contract between the borrower and the lender. All the terms, everything that constitutes default and the consequences of a default. Personal guarantee. Most small business loans will need to be personally guaranteed by the owner or owners. Why would the lender do that? Because back to the banks want to and need to earn money and interest. So, pardon me. Let me step back to that. Personal assets, real estate, they want a personal guarantee, which is almost the same as collateral, from my opinion. Prepayment penalty, I thought this was crazy. Their fees charged to the borrower who pays off all or a portion of their loan prior to maturity. And I thought that was crazy because the banks want to get their money back, right? But when they're lending out money, the way they're making it is on the interest that you pay. If you pay that back early, then they lose out on maybe 15 years of interest from you. So they make that up with a prepayment penalty. Loan amortization, those are essentially the principal and interest payments that you pay until all your principal's paid down, till your loan is paid off. Guaranteed loans, you guys are probably more than familiar with this with FHA lending in the housing industry, but also SBA guarantees and USDA guaranteed loans, and they have guaranteed loan programs. Credit score. I think this will be the second time I've talked about this. It's a mathematically derived number that statistically predicts how a borrower is to default on a loan, how likely a borrower is, pardon me. And there's both business and credit scores. Debt service coverage ratio. Basically, what banks are looking for is a debt service coverage ratio of 1.25% or higher, which means for every dollar that they lend you, they want to see that you're making $1.25, $1.25 over and above that. So a debt service coverage ratio of 1 means you're making $1, you're just barely covering your debt. If it's 0.8, you're not covering your debt. But if it's 1.5, that's even more excited for the bank because they're more likely to get their money back. Pro forma financial statements. We also call these financial projections, but the bank's going to want to see not only your maybe 3 years of taxes. If you don't have that, they'll maybe say 1 year of taxes if you've got that, and 2 years of projections. And they also probably going to require a personal financial statement that lists your assets, liabilities, sources of income, your banking statements and so forth. We're halfway through. It's quick stretch going down from here. Okay, so agenda for this section. We've already talked about the different types of capital. We've already talked about traditional and non-traditional financing. I hope you guys have a good idea of that. We talked about myths and a lot of realities of funding a small business. So what we're going to do in this section, on this agenda, is going to ask the question and answer the question, what, why, and why not of various types of financing. Then we'll talk about everyone's favorite topic, credit. From there, we'll talk about the big 3 financial statements. Well, let's start with the what, the why, and the why not. What are my options? So personal savings and bootstrapping, that was an answer for a number of people where their financing comes from and should. I mean, about 66% of small businesses are funded that way, according to a 2023 Small Business Credit Survey released by the Federal Reserve. So That's the way I started mine out, and that's the way we get going. You've got family and friends. It can take the form of a loan, equity, or a gift. But remember, if you're borrowing from family and friends, you want to do it in a business-like manner. You want to lay out the terms, draw up a contract, and communicate, just similar the way a bank would do as far as contractually. Um, and I'd say communicate, because you don't want your holidays to become awkward. Well, if you borrowed your money from my mom, virtually every phone conversation would be awkward. So friends and family, I have experience in, and it's hard to ask for money from them. It's also equally hard when you're talking to them on the phone. You've got national and super regional and commercial banks, such as TD Bank, Wells Fargo, First Citizens. They typically offer the best rates and best terms to the desired or their desirable clients. They provide credit cards and lines of credit, and even to startups, commercial real estate loans, term loans. But frankly, as a new business, getting a loan versus a credit card from them solely on the strength of your business and business plan is a low probability affair. We'll talk about that later, but in a little more stringent credit, extended loan approval timeline, and may lack flexibility. Then you move down a little smaller to the regional community banks and credit unions, like First Palmetto, Optus, South Carolina Federal Union. They have the similar product offerings as the larger banks do. And as far as the why not, they probably lack a little more flexibility because their focus is on local and community lending. So they may have a little more flexibility there. Microloans. These come from places like Community Works, Community Loan Fund, Climb. Typically, they have a maximum loan amount of $50,000. And see, they're offered through various community development organizations, Community Works, Climb, and so forth. And one thing I do want to point out, little to no collateral is required. It's designed for smaller businesses to promote capital access. Community development organizations, just mentioned these, Community Works, Community Loan Fund, might as well say Climb, and the Upper Savannah Council of Governments. They're entities have been created to serve a purpose, specifically a purpose to provide loans, investments, and financial counseling to targeted communities. Okay. Again, more lenient credit standards, product offerings are somewhat limited, and amounts will be capped for some lending products. Like I mentioned, a microloan. Okay, community development organizations are mission-driven private entities funded by public and private sources. They typically focus on financial counseling, lending, banking services to underserved communities and affordable real estate and housing as well. You got your community development financial institutions, your CDFIs, your community development corporations, your CDCs, and there's one other form, the CDO, I'm not sure, but they relate specifically to real estate and private housing. So that's not something we will review at this point. Just breaking it down a little further, the CDCs are affordable housing as well as real estate, SBA loans as well. The CDFIs provide microloans, business loans, and lines of credit. And it could be a depository institution or just offer training annual capital. It could be a bank or it could be a quasi bank. But for most small businesses, the CDCs and the CDFIs especially are the ones that should be on our radar as a small business and for capital. They've got the state small business credit initiative program. These slides, I'm just going to do a little deeper dive into it. I mentioned this on several other slides, but basically the credit initiative works with and through lending institutions and private equity firms in developing capital to historically underserved communities that on average are below risk-adjusted market rates and terms. It's pretty fancy speaking, isn't it? But generally speaking, the biggest drawbacks from this program is the limited number of institutions, lending institutions, that are participating. If a new institution wants to participate in this, they'll need to apply to participate. And the overall underwriting time is longer than for conventional loans, and pretty much it does exclude startups. If you don't have at least 1 year tax returns, then we'll have to find another financing option for you. All right, let's take a deeper look at the SSBCI loan program. Basically, the goal of the SSBCI is to strengthen the lending programs that support small businesses and job creation in individual states. So in 2021, the American Rescue Plan Act allocated $10 billion, with South Carolina's portion being $100 million, of which is split between 50% as loans and 50% as direct investments, which would be venture capital. Credit enhancement and loan guarantees to participating institutions. Basically, what they're trying to do is lower the risk of the lending institution, and I'll go into that in a little more detail. It's offered through CDFIs, traditional financial institutions, and venture funds. Could be in the form of debt or equity. And it focuses on socially and economically disadvantaged individuals, SETI, as you may have heard that term, and very small businesses, which is less than 10 employees. So what exactly does a SETI mean, a socially and economically disadvantaged individuals? A business owned by a socially and economically disadvantaged individual has a specific legal meaning, and it's fairly broad. It's a business that certifies that it is owned and controlled at least 51% by individuals who have had their access to credit on reasonable terms diminished compared to others in comparable economic circumstances due to, now this slide's a bit dense and contains a lot of information, but I think it's important that everyone who can qualify for this program should take advantage of this program, and just do not assume you don't qualify. So comparable, gender, veteran status, disability, limited English proficiency, a group that's been subjected to racial or ethnic prejudice. These are what a socially and economically disadvantaged individual owned and controlled business would be. So our loan programs, as we mentioned earlier, the SSBCI consultants, such as myself and 4 other individuals across the state, provide the technical assistance, which, if you recall, would be anywhere from working with your business plans, getting your financial statements together, working with accountants, getting the financial statements together, working with attorneys, making sure your legal's racked up correctly. So we help orchestrate that to provide technical assistance for this program. The allowable uses for the SSBCI loan program is for owner-occupied real estate. For instance, if you're wanting to buy real estate and occupy a minimum of 50%, 51% of that, then you would qualify under this caveat of the loan. Also for real estate upgrades and purchases of equipment. The way the program works is the financial institution, the bank, the individual bank, and the community that you're dealing with approves and closes a loan. And then Business Development Corporation, part of this whole network of money, assumes the risk of loss on loans from $50,000 to $1 million. If I had $100,000 loan from the bank would be on the line for $100,000, right? Right, typically. But what the BDC does, they'll provide, in this case, up to 49% of that loan coverage. So the bank's only on the for $51,000 risk. So it makes it more palatable, I guess, to loan and take a risk, because you're not taking the full risk each you would with a traditional loan. There's no additional BDC fees for that. Other types of lenders, why not? A small business administration. Again, I had mentioned that 99% of the time they do not actually lend money. They just provide a backstop to lenders who do lend money. And typically they have more lenient credit standards than a conventional lender. But on the other hand, they're guideline driven. There's not much flexibility. And the underwriting process can be a bit long, like 60 days or so. Venture capital and angel investors. For those that aren't familiar with venture capital or angel investors, venture capital firms are professional investors. They pool money and then invest others that money into companies. Okay, they actually could take the form of equity or debt. Angel investors are typically high net worth individuals, typically investing their own money. An example, well-known example that might be Shark Tank, where the individuals there compete to loan you money. All right. But typically, I know you'll see on Shark Tank, but typically along with venture capital or angel capital, you get an access to a network of resources, which are really beneficial for a young, fast-growing company, which is the type that venture capital targets. On the other hand, as we mentioned, equity, over the long run, equity capital can be really expensive because you're giving up ownership, you're giving up a claim on all future returns generated by a portion of your business or ever. And again, I think I mentioned the venture capital firm that wants to install their own CEO as well as several board members onto one company that they are going to invest into. You've got your supplier and vendor financing, collateral-based lenders. You guys are familiar with you buy now and you pay later. So vendors and suppliers just allow you to purchase today and pay in the future, paying on terms or whatever it might be called, payment terms. But the vendor really is extending credit terms to the purchaser. And a collateral-based lender just utilizes the business assets, inventories, invoices as collateral for the loans. Fintech, again, kind of what they are. They're online. They're typically unregulated entities that make algorithmic lending decisions. So again, the Federal Reserve Board, Federal Deposit Insurance Company, Securities Exchange Commission do not regulate them. So there's a lack of regulatory oversight. There tends to be a higher delinquency rates than bank loans. Their interest rates can tend to be much higher. One of our client now is looking at a loan. It might have been from QuickBooks, that's around a 25% interest rate. She needs it now, though. Next year, we'll get the planning done. So when the inventory cycles around, we'll have the right plan in place, not a high interest rate. Fintech lenders, okay. Some examples of those. You might have heard of SoFi, Affirm, On Deck, Funding Circle, or just to name a few of the lenders. Then you've got crowdfunding, peer-to-peer lending. Basically what it is, individuals going to pool their money to lend it or invest it or gift it without the help of traditional intermediary. In other words, it doesn't go through a bank or a financial institution. You've heard of Kickstarter. Actually, Peloton was started with a Kickstarter campaign. You've heard of GoFundMe. I've actually used GoFundMe for medical bills, not for business. Yeah. So there's seller financing. If you guys or any of you are looking to buy an existing business, there's a good chance the seller will finance that to you. So they provide pretty much some or all the capital that you need to purchase the building, the business. Most cases you won't need as much credit to qualify. Kind of flexible terms. You guys can craft the plan out together. Make sure you have good documentation, and make sure that you structure the terms to be not advantageous to either one of you, but just to be mutually advantageous, I guess would be the right word. Grants. This comes from the USA.gov, which is a government website. Grants. The federal government does not offer grants or free money to individuals to start a business or cover personal expenses. Contrary to what you might see online or in the media, websites or other publications claiming to offer free money from the government are often scams. Report them to the Federal Trade Commission. Okay, yeah, so basically be careful about online influencers or YouTubers offering you riches in the forms of grants. Now, there is grants out there. You guys, everyone knows about it. It's my number one asked question. Do you do grants? And my number one most disappointing answer, no. We do not do grants. If you are looking for a grant, you need help writing a grant. With SSBCI, we can help you with that. We have certain individuals that are very skilled and qualified at that. But grants are nice. The funds don't need to be repaid. It doesn't dilute your capital, and you could have some restrictions on it. They're typically not that large. They're not, enough to fully fund a business. The sources that they come from, it's challenging to uncover opportunities. The best thing to do is where do I get grants? Do a Google search for that. Grants.gov is one area. SBA, I believe, no, it's National Chamber of Commerce has got an area of other grants, but they are for a um, specific reason. We'll go into that. But the final why not, the administrative burden could be high. There's a lot of reporting involved. In fact, you may even have to have participation such as matching the funds or investing a percent of the business yourself. So grants aren't necessarily free money. So grants, they can be highly targeted, they can be specialized or random. The SBIR, STTR are programs of the SBA, the Small Business Administration. Basically, it's for existing companies with services that have or products, usually in the tech nature, that have commercialization potential. If you got foundations that have targeted grant opportunities, targeted could be anyone they want to target. It could be being a woman-owned business. It could be a hospitality business. It could be for being left-handed, whatever it may be. That they, if they're given the money, they can set the grant. So it's just a matter of you doing your research to find him, and also bear in mind in grants that you're not the only one applying for it, and this is a limited pool. So one or two or three people may receive this grant out of what thousands that apply. So it's a um, well, it's they're not easy to get once you do find one. Now, let's go on to everyone's favorite topic, credit. What's in your credit score? What compiles your credit score? What makes up the decision process of your banker to lend you money? Typically, you guys maybe have heard of the 6 C's of lending. Well, you maybe heard of 5 C's of lending, and that's, I think, somewhere along the line of 6C was added. but the first C is for your character or credit, your FICO score. So most conventional lenders require a minimum credit score of 650, as well as your credit character. The banks are also going to check your history about any criminal history. They're also going to check and see if you have any bankruptcy filings. Bankruptcy filings in the near past, the last 1, 2, 3 years, probably will disqualify a borrower. The next C is capital. Basically, banks, that they're putting money into you. They want you to put money into. They want to see that you have skin in the game. So expect to make some kind of down payment or some kind of equity injection of 10% to 30% of the amount you want to borrow. The SSBCI program I failed to mention on the slide is a 5% down or capital required. The next C is capacity. How are you going to repay the loan? Does your business profitable? Does it have a high probability of profitability in the near future? What other sources of income do you have? And also, how leveraged are you right now? I mean, do you have a house payment, several car payments, maybe equipment payments? So the lenders are going to look at those payments, your car loans, your personal lines of credit, and so forth, especially for a new business, to see if you have the capacity actually to repay the amount of money that you're borrowing. Collateral, it's really important. It's really what this sounds cruel, but it's anything that you own that can be seized and sold by the lender if you don't repay your loan. That sounds cruel. It could be your house if you put it up as collateral. Could be vehicle. It could be if you've got a portfolio of stocks and bonds, machinery, equipment. Just keep in mind, if you take out a business loan, expect your personal assets to be used as capital, or business assets as well. Next, there are conditions. What are the economic conditions? Does Do you have a business that banks want to be involved in? I mean, right now, well, let's go back to COVID. The banks had no appetite in lending to restaurants or eating established during COVID or even after that. So, the economic environment may preclude you from getting a loan from that facility or for that industry you're in. In addition, some banks have a portfolio. They want to have X amount of loans from this business sector, X amount from this, X amount from this. If they've got all they want, the loans for their portfolio of the, say, retail sector, they won't look at any further loans in the retail sector, even though you may be a valid consumer. All right. And the final latest edition of the CCs, the CCCCCs, is what confidence does the bank have in you? Or have you inspired confidence in the banker? If you've got a checking account there, is it overdrawn, or does it always stay right in the black? Are you interacting with the banker and the business manager? Do you reply to his emails in a timely manner? Also, do you have a history of experience in that industry? Or do you have a history of success in any other industry? Basically, does the banker want you as a customer? So let's take a look now at personal credit. Starting here, and then we'll move on to business credit. I think I've gone a bunch into FICO credit scores range from 300 to 850. Average FICO credit score for South Carolina is 699. A score between 740 and 850 is very good to excellent credit score. A score of less than 580 or so in the 500 isn't. 65% of your score is based on your payment history and your credit utilization. The other 15%, another 15% is based on the length of your history. How long have you had this open? How long have you been playing it? Primary personal credit bureaus are Experian, Equifax, and TransUnion. And I mentioned the free credit report. You go to annualcreditreport.com. And I believe you can do that. You can do it more than once. Let me just put it that way. But check that and see where your credit is. That'll give you an opportunity to see, hey, there's some things on here that don't belong here. I need to fix them. And then you also, you can get your credit, you get an idea of what's going on in your credit. So you see what the bank sees. And then you also, if you want to know your credit score, I mentioned earlier, myfico.com, myfico.com. Will help you to know your credit score as well. If you do the free service on them, it gives you only one lender. And all the lenders kind of vary actually, but to a huge degree, not lender, credit bureaus. Let's take a look at the business side of credit scores. I don't know really the lenders that I've talked to, many of them tell them they don't even look at the business credit score. So I might just kind of go through this a little quicker, but again, like personal, there's 3 business credit reporting bureaus, addition of Dun & Bradstreet instead of TransUnion. I've got this link on the handout you'll be getting at the end of the class. Each credit bureau has its own scoring model, but typically the score range is from 0 to 100. Then there's the FICO Small Business Scoring Service. It's a combination of the personal credit, business credit, borrower financials, and application data. It's also used as a screening tool, and their ranges range from 0 to 300. And minimum score for the loan is 130 to 155. And I'm going to pass through this right now. Well, yeah. Well, Sarah, do you mind throwing up that poll?
Okay.
I forgot to do that last. I guess both of them.
All right, and we should have that available for everyone to see. We've got 2 more questions, so we'll keep it up for about a minute.
I see the business plan. I see about 50% don't have a plan but want to create one. Again, that's where we can help at the SBDC. It's good to see that 35% have a plan. They regularly update it. So that's really good. Um, and then accounting software, as far as tracking the business expenses and revenue, kind of a question about that. QuickBooks is probably the name brand of all of it, which people can, can be expensive. There's other lower costs as well as if just as effective methods other than QuickBooks, and we could help direct you in some of those areas. Manual record keeping, 61%, and then 6% outsource the accounting services.
And
So
then also
that's
keep in mind that some people are looking to start a business so that they don't currently have anything to track right now.
true.
We do have a couple of questions. Did you want to wait
Yeah,
to
no,
take
it's good.
those? Okay.
Yeah.
So the first one is there a site or contacts to connect with on venture capital options?
Um, I don't know of a site. I think that would be something that could be Googled. I know of one in particular I'm working with in the Low Country. It's called Highmark Capital. And believe, Sarah, we might have to get that to them, but I know there's several others that are involved with SSBCI as well.
Okay.
So if I can maybe look that up and send it out later
A few.
to,
Yes.
okay.
And that is something that we'll try to make sure that if we are recommending that we're not just recommending one, but giving you multiple options of ones that we have vetted and can recommend you to go to. And then the second question is, do they need a DUNS number to get a loan?
No.
Okay. And that
And
is all for
you
now.
may already have a DUNS number, not know it, but
Yeah.
no, you do not need one.
All right.
All right. Financial statements. I guess when you think of the term financial statements, what do you think of? I think of it as a big mess because I'm not really good with numbers in a lot of cases. But income statements, financial statements are made up of three basic statements: a balance sheet, an income statement, and a cash flow statement. The balance sheet shows where your company stands at a certain point in time. The income statement and the cash flow statement um, covers a period of time, which could be a year. You'll see in our examples, it's a year, but it could do it for a month, for a week, however you want to do. And again, accounting software sure makes this a lot easier. And it should conform to generally accepted accounting principles, which are basically standards and practices in the industry to prepare and standardize financial statements. All right, let's take a little closer look at the big three. We've got the income statement. It shows your total sales, generated COGS, and cost of goods sold, and expenses incurred by the company over a specific period. It's kind of also called the profit and loss statement. I don't know if y'all may have heard that before. Um, Second one is a balance sheet. It's probably not as important or as popular as the income statement, but it tells you the net worth of the company. It tells you, yeah, it tells you the net worth of the company, not how much you can sell the company for, but it's the net worth of the company. And the cash flow statement, which basically tracks the cash coming in and out of your company. How much the company produced, raised, invested uh, over a certain period of time. The income statement looks like this for Sarah's Bagel and Donut Cafe. In this case, we're reporting over a period of time. So we've got 2022 and 2023. We see the revenues or top line is $225,000. That's the money that came in because they sold their product or service. In 2022, it was 175,000. So we see a good increase there. Their cost of goods sold is the elements that went into making that product. So simplifying it, I have a lemonade stand. The goods that I need to produce lemonade are lemons, ice, sugar, water. Yeah, I think that's about it. So those would be the goods, the cost of the goods sold there. Subtracting that out shows you your gross profit, and then your gross profit margin of 60%. And again, we can see over the years that this has increased and gotten better. Then you've got your operating expenses, taxes, interest, rent, and utilities, marketing, general administrative, depreciation, and you subtract those out and you get your pre-tax income or loss. And again, we see from 2022 to 23, those numbers have increased. So those are taxes. And so the net income, in this case, of this company has increased, almost doubled over the year. This is just another variation of the same statement. It's called a common sized P&L or income statement. It's got the same elements in it. It's just the difference you're going to see is there's a column of percentages on the right side of each number. And basically, these are all related to or have in common the revenue number. So it all goes back. Everything number here is a percent of revenue. So where's this come in handy? When a company wants to compare how they're doing to the industry, nationwide or just in a particular region, these ratios are readily available, and we have just access to them. So we can compare your company's financials or ratios to what the industry standard might be and see where maybe some improvements need to be made. Maybe your cost of goods sold is a lot higher than what it might be in the industry. Maybe your marketing's a lot lower than what's going on in the industry, but these percentages help us benchmark where you are. My question, we've got 60% gross margin right there. Kind of hypothetically, is that good or is that bad? I think it's really good. However, that's relative, right? On an absolute basis, it looks good, but relatively, what would we would need to know what the average gross profit margin of the industry is to see if that's good or not. Next, we have the balance sheet, Sarah's Bagel and Donut Cafe. So remember the balance sheet is assets, liabilities, and owner's equity. So the assets right here, which would be cash, accounts receivable, and inventory. So the total current assets, those are things that can be turned into cash fairly quickly. Fixed assets, furniture and fixtures, baking equipment, accumulated depreciation, so your total fixed assets. And then your liabilities. And accounts payable is a liability, equipment loan, total liabilities. And then you've got the owner's equity, their investment, the retained earnings, and the total owner's equity lines up to be what the total liabilities and equity are for the year 2023. Again, you can progress it throughout the years, and you can do this monthly, quarterly, whatever area you want to take a look at. So it's kind of, we're sliding into a little bit of definitions, but because it kind of fits up with this slide, so I'm adding it in. Assets are what a company owns, what has value, what can you sell, like cash, inventory, land, buildings, FF&E, furniture, fixtures, and equipment. And liabilities are what a company owes, short-term debt, salaries, sales tax, accounts payable, so forth. And the owner's equity is what remains after all the liabilities of the company are paid, is the net worth of the business. But again, as I mentioned, it's not necessarily what the business is worth. So what a company owns minus what a company owes equals the company's net worth. And final one is the cash flow statement. Taking a look at where your cash comes from, operating, from investing, and from financing activities. We see the beginning cash balance of $29,500, $31,000, which we came from the net income statement for the income statement. And then operating activities where the cash came from. Looks like they bought cash from. So in essence, ending cash balance, 56,284, 29,500. So again, it's almost doubled. Sarah's cooking out some pretty nice bagels. I'm going to kind of breeze through these financial ratios. I just want you to be aware of them. I'm not, I would assume that probably 90% of you, that might be high, 50 at least percent are not really doing these particular ratios, but they're good to know, and you will be probably doing them as time goes along. These are also included on the handout sheet that you'll get at the end of the session. That includes the definitions as well. So gross profit margin, it's a key profitability ratio, just tells you how much dollar is generated by sales is able to pay expenses. Net profit, it's another key profitability ratio. Tells you if you're making money after all the expenses have been paid. Debt service coverage ratio, which we mentioned earlier. It's your net operating income divided by debt service. Working capital, current assets minus current liabilities. If you subtract that out, really it's not a ratio, but if you had to pay off all your short-term liabilities today, could you do that without much strain? Do you have a lot of current assets to pay off the current liabilities? Debt to equity, it's kind of another thing, but it's considered a solvency or a leverage ratio, like how solvent is your company. And this one, the lower the ratio, the better. You've got return on invested capital, inventory turnover. These two are important if you're have a retail business or carry inventory. Oh, fight me. Accounts receivable turnover and accounts payable turnover. Okay. Sorry to run through those quickly. We probably, if we wanted to really do a deep dive, could spend a lot longer than that. So some more terms and definitions. Revenue, it's kind of listed as sales maybe on the P&L. It's the top line number there. If you don't have any revenue, if you don't have any revenue, you have a hobby. And if you have no revenue and expenses, you have an expensive hobby. Gross profit or income, calculate your gross margin. It's just an important ratio that everyone should know for their business. Cost of goods sold, I kind of mentioned that with the lemonade stand. Expenses, costs incurred in the ordinary course of business, maybe fixed or variable, and they're listed on the profit loss statement as operating expenses or SG&A. Sales general administrative, selling general administrative expenses. Retained earnings. These are the profits that you earned by the company and you did not take any dividends or owner draws out. So the bottom line, where we saw the owner's equity, where it increased, that's retained earnings. The accounts receivable is money due to a company for goods or service that is delivered, but hadn't received payments from the customer. So I'm selling widgets is always an example, and I sell them to ABC company, and they buy 500,000 of them, $500,000 worth, but they don't pay me until for 30 or 60 days out. Those are accounts that are receivable. It's money due to me. Accounts payable is the opposite end of that. I have bought $500,000 worth of widgets for my business, but I'm not fully paid for that yet. Inventory, the materials used in production, the lemonade I mentioned, or it could be inventory that's on your shelf, or stuff that includes work in progress, process finished goods. Okay. So wrapping it up, again, this is on the handout too as well, but don't be shy about seeking assistance when needed. SC SBDC.com and request counseling. Click on the thing there. If you're looking for SSBCI loans or funding, you'd go SC SBDC SCSBDC.com /SSBCI. And if you want counseling there, you'll click on the green button and you'll have an SSBCI counselor contact you. Perform your needs assessment. We'll help you with that. Check your credit. You've got now the tools to do that, and then make any needed repairs or improvements to your credit. Update your financial statements and your business plan. Update and review them. You know how much you can afford to buy, how much loan you can afford to get based on your capacity to pay. I've gotten pre-approved for X amount of dollars before, and I thought this is great. But I look at it, but I didn't really have the capacity. Well, I might have had the capacity, but it made it really tight living. So that wasn't a good loan for me. Determine what type of financing is more appropriate for you, non-traditional, traditional, or maybe a combination. And don't enter into any agreement without fully understanding all the terms. All right, agreement being buying a business, a banking agreement for a loan, just fully understand all the terms. It could come back to bite you. And I think I mentioned this before, plan ahead. It's always hardest to get cash when you really need it. Um, so, you can get it quickly, but you're going to pay for it. So if there's some of you out there that want to work with us, I mentioned the website. I hacked it up doing it by memory, but here it is. You can check your writing, scsbdc.com / SSBCI. Get there and select counseling, the little green button right above, right there, not the top one, which is blue, I think, the green one below. And that would contact our office, which will arrange an appointment with you. You meet with a consultant, whatever region you're in. You could do it by Zoom, you can do it by face-to-face, what works best for you. And then we discuss what your goals are, what your hindrances are, what you want to get done next. And we'll work on tasks. We'll give you tasks to work on that action plan. The same token, you can get the training you need again at our website, SCSBDC.com, and it's under the column that says training events. And again, that shows the events that are not only have taken place and they're recorded webinars, but also the ones that are upcoming. And we do have a broad range of topics, really broad range. And finally, is there any questions?
It looks like we've got one. What are good resources to search for industry standards, gross profit, net profit, labor, cost of goods sold, rent, lease payments, etc.? My industry is restaurant, but in industry. Also for specific demographic information for a specific area. So through the SBDC, we can do industry reports. We've got access to quite a few things that we can do projections and market analysis. So I know
Yeah,
we've got IBIS World, Profit Sense, a lot of things that you would have to pay a company a lot of money to do that analysis. We can have access to that for free for you because our organization pays for it. So it would just be a matter of you getting set up with a consultant and going through that one-on-one. So it's not anything that we would have public access to, but you would have to go through your counselor to get that taken care of for free.
yeah. Okay, yeah, I was wondering if there's anything that was actually free outside of us. All those plans require a subscription, so, but it does,
Yeah, maybe local libraries or other, university institutions would be able to offer that to the public either at no cost or low cost. But I would recommend going through and making sure that you're looking at the accurate industry, the accurate location, and having a business consultant kind of hold your hand through that process as well.
I agree, yeah, and that will answer all the numbers that you're looking for.
And then I did put the funding guide and the terms and conditions handout, as well as the link in the chat box as well. So anybody that needs access to that, just check the chat.
All right. Well, I thank you all very much. I appreciate your time and attention. I hope that there was something here that you can benefit from. And I again appreciate your time. It was a long amount of time, and please feel free to call SC SBDC for any of your business needs, and we'll see where we can help you. Thank you very much.